Let me tell you about the most dangerous financial advice circulating right now. One for Amatundum tez, injuos het genderisham. What meri was in fenkum betain you, mundirun korsing for modins than core. The kind that sounds brilliant when you hear it, but quietly destroys people's lives while they're convinced they're doing something genius. This isn't about obvious scams or get-rich-quick schemes. This is about advice that comes wrapped in the language of ambition and courage. Advice that makes you feel like you're part of some enlightened group who gets it while everyone else is stuck in mediocrity. And the worst part? The people giving this advice are often wildly successful, which makes it almost impossible to see the trap until it's too late. Here's what I mean. You've probably heard some version of this. Take massive risks, bet everything, go all in, safe as death. If you're not willing to lose everything, you don't want it bad enough. It gets repeated by founders, entrepreneurs, tech leaders, motivational speakers. It sounds electric. It sounds like the secret that separates winners from losers. And for about 98% of people who follow it, it's a catastrophe they never recover from. But here's where it gets interesting, and where most people miss what's actually happening. The advice itself isn't necessarily wrong for the person giving it. That's the trap. When someone worth hundreds of millions or billions tells you to risk everything, they're not lying about their experience. They probably did take massive risks. They probably did bet everything multiple times. What they're not telling you, what they genuinely might not even realize themselves, is that their circumstances when they took those risks were radically different from yours. And that difference isn't just important, it's everything. Think about it like this. Imagine two people standing at the edge of a canyon. One person has a state-of-the-art parachute, emergency backup chutes, a support team, medical insurance, and a safety net at the bottom. The other person has none of that. Now imagine the first person turns to the second and says, "You know what changed my life? Jumping off cliffs. You should try it." That's what separates people who make it from people who don't. Technically, they're sharing their genuine experience. They really did jump, and it really did work out. But the advice is criminally incomplete because the context is everything. This is what I call survival bias weaponized as wisdom. And it's everywhere. When someone who came from wealth tells you to quit your job and pursue your passion, they're probably not considering that they had a family safety net you don't have. When someone who made it big in their 20s tells you that you should work 100-hour weeks and sacrifice everything, they might not be factoring in that they were young, single, healthy, and didn't have people depending on them. When someone tells you that you should put all your money into a single big bet, they might not mention that the first 3 times they did that, they had family money or investor backing to fall back on when it failed. Stay with me, because this gets darker and more important. There's a specific type of successful person who gives this advice constantly, and they're genuinely trying to help. They look at their own journey, and they see the moments where they bet big, where they ignored the naysayers, where they pushed all their chips to the center of the table. And those moments feel, in retrospect, like the turning points. So they extrapolate from that, risk equals success. But what they don't see, what's invisible to them, because of how memory and survivorship work, are all the people who made the exact same moves at the exact same times, and got obliterated. Here's a thought experiment. Imagine 1,000 people all decide to start companies in the same year. Or they all work insanely hard. They all take huge risks. They all max out credit cards, skip paychecks, sacrifice relationships, bet everything on their vision. 5 years later, maybe 10 of them are successful. Maybe one of them is massively, generationally successful. That one person will probably, in good faith, tell you that the secret was working hard and taking massive risks, and they'll be right about what they did. But 990 other people did the exact same things, and ended up bankrupt, divorced, broken, starting over from worse than zero in their 30s or 40s. The advice wasn't wrong, the advice was incomplete. It was describing necessary conditions, not sufficient ones. And that difference will ruin you if you don't understand it. Now, here's where this connects to something you need to understand about how wealth actually compounds, and why this aggressive risk-taking advice is particularly destructive for people who don't already have money. There's a concept in physics called escape velocity. It's the speed something needs to reach to break free from a gravitational field. Below that speed, no matter how hard you try, gravity pulls you back. Above that speed, you're free. Financial life works the same way. There's a threshold, an escape velocity point, where your money starts working for you, instead of you working for money, where compound interest and passive income and investment returns become significant forces in your life. But here's the brutal part. Getting to that escape velocity point requires 2 things: time and consistency. Not heroic all-or-nothing bets, not lottery ticket thinking. Time and consistency. Let me show you what I mean with actual numbers, because this is where it gets visceral. If you invest $500 a month with a 7% return, which is conservative for a diversified index fund over time, after 10 years, you have about $87,000. After 20 years, you have about $260,000. After 30 years, you have about $600,000. After 40 years, you have about $1.3 million. That's not exciting. That's not going to make you feel like a visionary. That's just math being relentlessly, boringly powerful. But now imagine someone who listened to the take massive risks advice. Maybe they took that same $500 a month, and instead of investing it steadily, they waited until they had enough to make a big bet. They put it all into a hot stock tip, a friend's startup, a crypto project that seemed like the future. And maybe, if they're lucky, 1 out of 5 of those bets pays off. But the other 4 wipe them out. So they're constantly starting over. They reach 35, 40, 45 years old, and they have nothing. Not because they weren't ambitious, not because they didn't try, but because they followed advice that was designed for people playing a completely different game with completely different safety nets. And here's what nobody tells you. The people who make it big on massive risks, a huge percentage of them already had money before they took the risk that made them famous. They had money from family, from a previous exit, from years of high income they saved. So when they bet big, they weren't actually risking destitution. They were risking going back to being merely comfortable. That's a completely different psychological and practical calculation than someone betting their last dollars or going into debt to chase a dream. I need you to understand something that's going to sound cynical, but is actually just true. There's a whole ecosystem of people who benefit from you taking massive risks with your limited resources. Venture capitalists want you to start companies because they profit from the 1 in 100 that succeeds. And they don't care about the 99 that fail, because they're not the ones losing the years of their lives and their life savings. Platforms and gurus want you to believe that aggressive risk-taking is the only path, because it makes for better content, better stories, more engagement. The person who steadily invested and retired comfortably doesn't go viral. The person who mortgaged everything, slept in their car, and somehow made it does. But the selection bias in what stories get told is creating a completely distorted picture of what actually works for most people. Here's another angle on this that's even more insidious. About when you're told to take massive risks, there's an implicit moral judgment embedded in the advice. The subtext is, if you don't take these risks, you're not serious. You're not committed, you're playing small, you're letting fear run your life. And that moral framing is incredibly powerful because nobody wants to see themselves as cowardly or uncommitted. So people take risks they can't afford, not even because they genuinely believe those risks are smart, but because they don't want to feel like they're the kind of person who plays it safe. They're performing courage for themselves and others, and they're doing it with their financial lives as the stakes. But real courage, adult courage, often looks like discipline. It looks like saying no to the exciting opportunity that could change everything, because you can actually calculate that the downside would devastate you. It looks like building slowly while everyone around you is trying to get rich quick. It looks like being the person at the party who doesn't have a sexy startup story to tell, because you're just methodically building wealth through boring index funds and consistent savings. That's not cowardice. That's playing the long game, in a world that's constantly trying to get you to sprint off a cliff. Let me tell you about the actual math of financial recovery, because this is where the massive risk strategy reveals itself as truly destructive for most people. If you lose 50% of your money, you need a 100% return just to get back to where you started. If you lose 75%, you need a 300% return. These aren't just setbacks, these are catastrophic losses that can take decades to recover from, if you ever do. And every year you lose in your 20s, 30s, 40s, is a year you can't get back for compounding. Remember those numbers I showed you earlier? The person who invests $500 a month for 40 years ends up with $1.3 million. But if they start just 10 years later because they spent their 20s chasing big risks that didn't pan out, they end up with about $600,000. They lost half their potential wealth by losing a decade. Now, I'm not saying never take risks. That's not the point. I'm saying there's a specific type of risk that successful wealthy people take that they then generalize into advice that doesn't translate to your situation. Let me break down what I mean. There are 2 types of risk. There's risk where you can survive failure and try again, and there's risk where failure means devastation you might not recover from. Wealthy people, people with safety nets, people with high incomes or family money, or previous successes, they mostly take the first type of risk, even when they think they're taking the second type. If their startup fails, They're disappointed and they have to figure out their next move, but they're not homeless. They're not bankrupt. They're not starting over at 40 with nothing. But when someone without those resources takes the same risk, and it fails, that's a different story. That's years of recovery. That's sometimes bankruptcy. That's damaged credit. That's lost time that they can never compound back. So here's the framework you need, instead. Before you take any significant financial risk, any bet the farm move, ask yourself these questions. 1. Can I survive the worst-case scenario and still build wealth afterward? Not just survive in the sense of not dying, survive in the sense of being able to continue your financial plan. If the answer is no, the risk is too big. 2. Is this risk one of many bets I'm making, or is it my only shot? If it's your only shot and it doesn't work, you're cooked. Successful people make lots of bets. They can afford to have most of them fail, because they have multiple attempts. 3. What's the opportunity cost? What else could you do with that time, energy, and money that would be more certain to build wealth, even if less exciting? Here's where this connects to something crucial about how wealth actually works in the real world. Wealth is not built primarily through home run moments. I know that's not what you see on social media. I know that's not what the stories tell you. But statistically, overwhelmingly, wealth is built through decades of consistent behavior. It's built through living below your means. It's built through automating savings. It's built through investing in diversified assets that you don't touch. It's built through increasing your income over time through skills and career capital. It's built through avoiding catastrophic mistakes. And that last one is the most important. Avoiding catastrophic mistakes. Because here's what the take massive risks advice gets backwards. In wealth building, it's not about hitting home runs. It's about not striking out. It's about staying in the game long enough for compounding to do its work. And every time you take a risk that could wipe you out, you're risking your ability to stay in the game. You're risking the most valuable asset you have, which is time. Time in the market. Time working, time compounding. Time building skills and relationships, and career capital. There's a reason why some of the most successful investors in history, people who built genuine multi-generational wealth, are famous for being boring. They're famous for saying no to exciting opportunities. They're famous for having rules and sticking to them. They're famous for patience, not because patience is sexy, but because they understand that in a game played over decades, consistency beats heroics almost every time. The person who averages 7% a year for 40 years beats the person who makes 50% one year and loses 30% the next, over and over. But here's what makes this advice so particularly dangerous right now, in this moment. We're living in an era of unprecedented inequality, where the gap between people who have wealth and people who don't is wider than it's been in generations. And the narratives that get amplified are narratives about how people without wealth can become wealthy. And the most attractive, most shareable narrative is the one about taking big risks and betting on yourself and ignoring the doubters. That narrative serves the interests of people who need you to take those risks. It doesn't serve your interests unless you already have a safety net. Think about it. If you're a venture capitalist, you want thousands of people starting companies and taking huge risks, because you'll invest in the most promising ones and make money when a few succeed. You don't care about the 95% that fail, because you're diversified across many bets. But each of those founders isn't diversified. They bet everything on their one company. The VC is playing a completely different game than the founder, but they're both using the language of taking risks and betting on yourself, so it sounds like they're aligned. They're not. If you're a social media platform, you want inspiring content about people who risked everything and made it because that content gets engagement. And you don't platform the boring stories about people who saved consistently and retired comfortably, because those stories don't generate clicks. So the information environment you're swimming in is systematically biased toward making risk look smarter and safer than it actually is. If you're someone who already made it, sharing advice about aggressive risk-taking makes you look bold and inspirational. It creates a personal brand. It gets you speaking gigs and book deals and followers. Telling people to save consistently and invest in index funds, that doesn't build a personal brand. So even well-intentioned successful people are incentivized to share the dramatic parts of their journey and downplay the boring parts or the privileged parts. And here's maybe the darkest part of all this. The people who follow this aggressive risk advice and fail, they blame themselves. They think they weren't committed enough. They think they didn't want it badly enough. They think they were too scared. They internalize the failure as a personal deficiency, rather than recognizing that they were given advice designed for people in completely different circumstances, and that internalized shame prevents them from course correcting. They either keep making the same mistakes, or they give up entirely and become cynical, instead of adopting a smarter, more sustainable approach. Let me tell you what the actual good advice sounds like. The advice that works for people who are starting without safety nets. Build your escape velocity first. That means before you take any massive risk, you build a foundation. You build an emergency fund of 6 months of expenses minimum. You eliminate high-interest debt. You start investing consistently in diversified assets. You build skills and career capital that increase your income. You create optionality and margin in your life so that when you do take risks, and you will take risks, they're risks you can survive if they don't work out. This isn't sexy. This might take 5 or 10 years. But it's the difference between taking smart risks that can genuinely change your life and taking desperate gambles that are more likely to destroy your financial future. Here's the thing about escape velocity. Once you reach it, once you have a foundation, once you have money working for you, once you have options, then taking bigger risks actually makes sense. Then you can afford to bet on a startup. Then you can afford to take a year off to build something. Then you can afford to invest in speculative opportunities, not because you're braver or more committed than you were before, but because your circumstances changed. You built the parachute before you jumped off the cliff. But if you jump before you build the parachute because someone told you that building the parachute means you're not serious about jumping, you're going to get destroyed. And the person who told you to jump isn't going to be there when you hit the ground. Now let me show you what this looks like in practice, because I want you to feel the difference between these two paths viscerally. Imagine two people, both 25 years old, both making $50,000 a year, both with $5,000 in savings. Person A hears the aggressive risk advice. They quit their job to pursue their passion. They take their $5,000 and invest it in their startup idea. They put everything on their credit cards. They work 100 hours a week for 2 years. The startup doesn't work. They're now 27. They're $40,000 in debt. They have no job. They have a 2-year gap on their resume, and they're emotionally devastated. Even if they recover and get a decent job, they'll spend the next several years digging out of debt instead of building wealth. By 35, they might finally be back to zero. Person B hears different advice. They keep their job. They live on $40,000 a year and invest $10,000 a year. They work on building skills that increase their income. Over 10 years, their income grows to $80,000. They've been investing that extra income too. By 35, they have about $200,000 invested and growing. They have career capital. They have options. Now they can take bigger risks if they want, because they have a foundation. They can start that business. They can take a sabbatical. They can invest in opportunities. And if those risks don't work out, they still have their foundation. They can still retire comfortably. They're playing a completely different game. Which person do you think has more freedom at 35? Which person do you think is actually in a position to take meaningful risks? Which person do you think is happier and less stressed? Person A took the big risk early, and it set them back years. Person B built the foundation first, and then had real options. But the narrative we hear constantly is that person A is the courageous one, the one who really went for it. And person B is playing it safe, thinking small, not committed enough. That narrative is destroying people's lives. Here's what I need you to understand about the people giving this aggressive risk advice, even the ones doing it in good faith. They're usually talking about what worked for them during a very specific moment in their lives, often their 20s, often when they had very little to lose. And they're extrapolating that moment into universal advice. But they're not accounting for the fact that most people hearing that advice are in completely different situations. They might have kids. They might have aging parents to take care of. They might have health issues. They might have debt. They might be older and can't afford to start over. The advice that made sense for a healthy 25-year-old with no dependence in Silicon Valley in a specific economic moment might be catastrophically bad advice for a 38-year-old with 2 kids and a mortgage in the Midwest during a different economic moment. And nobody wants to hear this, but I'm going to say it anyway, because it's true. Some of the most successful people giving this advice didn't actually succeed because of taking massive risks. They succeeded in spite of taking massive risks. They succeeded because they were incredibly talented, or lucky, or in the right place at the right time, or had connections, or had 20 other factors working in their favor. The risks they took were just part of the story. But when they tell their story, the risks are the most dramatic part, so that's what gets emphasized. And then people hearing the story think the risks were the cause of the success, when they were actually just one factor among many, and maybe not even the most important factor. Let me give you a different way to think about this, that might change everything. Instead of asking, what risks should I take to get rich? Ask, what risks can I eliminate while still building wealth? Because here's a secret that boring wealthy people understand. Wealth is often more about what you don't do than what you do. Don't carry high-interest debt. Don't try to time the market. Don't invest in things you don't understand. Don't live beyond your means. Don't take risks that could wipe you out. Don't compare yourself to people playing a different game with different resources. Every one of those don'ts is protecting you from catastrophic mistakes. And over decades, avoiding catastrophic mistakes while doing the boring basics consistently will beat aggressive risk-taking for most people, most of the time. Here's my challenge to you, and this is where we get to the part that actually changes your life if you take it seriously. For the next year, ignore every single piece of advice that tells you to take massive risks, quit your job, bet everything, go all in. Just ignore it completely. Instead, focus on these boring things. Increase your income by building skills your market values. Live below your means, and increase the gap between what you earn and what you spend. Automate investing that gap into diversified index funds. Build an emergency fund. Eliminate high-interest debt. Do these boring things with intensity and consistency for 1 year. At the end of that year, you'll have built more real wealth and more real optionality than 95% of people chasing get-rich-quick schemes and following aggressive risk advice from people whose circumstances have nothing to do with yours. And here's what will happen that you're not expecting. As you build that foundation, as you create that margin, as you develop that escape velocity, you'll start seeing opportunities that you couldn't see before. Real opportunities. Smart opportunities. Opportunities where you can take calculated risks because you have the foundation to survive if they don't work out. That's when risk-taking becomes intelligent instead of desperate. That's when you're actually playing the game that successful people play instead of the game they describe playing. The most dangerous financial advice isn't the obviously bad advice. It's the advice that sounds inspiring and ambitious and courageous, but is actually describing a game you're not equipped to play yet. It's advice from people who had parachutes telling you to jump without one. And the tragedy is that by the time you realize you didn't have a parachute, you're already in free fall. So build the parachute first. Build the foundation first. Build the escape velocity first. It's not sexy. It's not inspirational. It's not going to make you feel like you're part of some elite group of risk takers who get it, but it's what actually works. It's what actually builds wealth. It's what actually gives you the freedom and options that you're chasing by taking risks you can't afford. Stop listening to people who are playing a different game than you. Start playing the game you can actually win. Your future self, the one who's financially free because you were patient enough to build the foundation, will thank you.